This is the European edition of Breaking Banks, the world's #1 fintech podcast and radio show. We bring you the European unicorns, startups, founders, regulators, and leaders innovating the rapidly evolving fintech scene today. A truly localized podcast with both English and local language content, with some of the world's most well-known hosts and influencers in the fintech sector globally. Join us every week as we explore what makes the European Union a phenomenal proving ground for many of the fastest growing fintech plays in the world today. Okay, let's roll.
Hi everybody, this is Matthias Kröner and this is Breaking Banks Europe episode number 71, if I did not miscalculate or miscount today. So today the topic is actually what we call news from the FinTech Front. With me in the show, I have two marvelous guests. Ladies first, Diana Biggs, and my good old friend and fellow Gerd Weissenboeck. And allow us to kick off the show by introducing the guys themselves. Diana, who are you? What are you doing? Why are you on this show? And just go for it.
Thanks. So I am CEO of Valour, which is an issuer of exchange-traded products based on disruptive innovations. So our current focus is on digital assets. We listed our first product last December, which is a product called Bitcoin Zero on the Nordic Growth Market Stock Exchange in Sweden. And we will be launching a number of new innovative ETPs very shortly this year. I'm also an associate fellow at Saïd Business School at University of Oxford, where I'm focused on cryptocurrency and blockchain technology as well. Thanks for having me.
No, great. I think we definitely will speak with you regarding the future trends a little later in the show then. What is the new hot thing in FinTech? Gerd Weissenboeck, an Austrian living in London. What are you doing there?
I have no idea, actually. I don't have any idea why I'm on this show. I think you ran out of guests, Matthias, after 71 shows, so I had to step in. No, I'm Gerd. I co-founded and run a fintech-focused investment banking boutique called Zelig. We advise, not surprisingly, on fundraising, venture and growth, and M&A. And I had the privilege to work with Matthias on several assignments in the past. I think I'll leave it at that.
Yeah, that's absolutely right. Gerd did, and we disclosed that very early now here in the show. Gerd did support us whenever we had corporate actions or corporate activities on the feeder group side. Gerd, we did kind of use you as a advisor and supported to this, so that we speak very transparently and open to this. May I, speaking about the news from the FinTech Front, actually, may I, because at least it impresses me a lot, can we speak about the most recent developments when it comes to valuation, corporate valuation? Obviously the sky's the limit. We hear, I only hear billions.
Bitcoin, $60,000.
Yeah.
For Bitcoin. And I own a maiden one, and I did trade it with Kraken, and that reminds me of a story I wanted to tell about Matthias and us being in the trenches. And one day I get a call from Matthias a long time ago and said, Gerd, I have an investment opportunity for you. Do you want to invest into the Series A round of a very quirky company from San Francisco called Kraken? And I said, well, what do they do? Well, they trade tokens of Bitcoin. I said, oh, what's that? Anyway, it was about 4 years ago. The valuation was, I think, $25 million. I checked last week. I think the valuation is now $20 billion. So I don't think, if I put $25,000 into this deal, I had 3 days to decide over the weekend, so I didn't do it. And I think Matthias didn't do it either, because otherwise neither of us would be here today. Anyhow, talking about valuations, COVID has only led to one thing, and that's valuation going up, multiples expanding, digital trends accelerating. If you're not exposed to retail or to travel, you're in a good place, or to SME credit for that matter. So I would say that 10% of fintech-focused companies probably were net losers, or maybe 5%. There's a meaningful percentage that was probably, it was neutral to them. But for many, it had very positive effects in terms of valuation, in terms of scaling their revenues. So valuations have definitely reached new heights. Multiples are expanding. There is a scarcity of valuable, interesting assets. There's a lot of liquidity chasing deals. Funds get bigger, rounds get bigger, and prices, as with Bitcoin, where there's limited supply, prices are bid up. That's the way it works. So one shouldn't quite talk about valuations per se, because it's all kind of prices, which are determined by demand and supply. And a pause here.
Yeah, but would we have assumed that development actually last year, being in the midst or in the beginning of that crisis, of that COVID crisis? First of all, I can recall that I myself, in all honesty and transparency, was definitely way more skeptical regarding exactly that development. So this is why I'm a bit, positively, of course, surprised that actually the whole thing is developing into this direction. We did another Breaking Banks Europe session, and that was approximately a year ago. We estimated what will be the year-end price of the Bitcoin. Only one, I think, guessed that it will be around $20,000 US. Myself, again, I was way more conservative on that. But would it be fair to say that the kind of valuation raise that we see there today is underlined by, first of all, maybe the venture caps and private equity firms kept their gunpowder dry for the last 12 months, more or less, kind of waiting where we will head into. Second, isn't it the case that we are distributing future market share now in a certain sense, so that it's all going, or mainly going, into digital businesses? Third, yes, you're saying not all fintechs are really benefiting from that, but isn't it that it's a kind of the winner takes it all mentality now, and we fund these companies unless they have the major market share on a global level?
There are lots of questions, I think, in that statement. Let's start with a simple one. So did we expect, or by that, I probably rephrase, did anybody expect what happened in the last 12 months in terms of valuation, in terms of deal activity, in terms of acceleration of digital trends? I don't think so. About a year ago is, I think, when the lockdown started, and me running a small company compared to a large bank or a larger fintech, etc., I sat down and was wondering, what does this all mean? And by the way, everybody else did the same thing. Like VCs, the growth equity firms, you couldn't reach them. You have to leave them alone, because they were sitting down, looking at their portfolio and going through the triage. What does it mean for my portfolio companies? And we have to make sure that they are safe. Can we, or if there are problems, can we fix it? Or if they cannot be fixed, we probably have to switch off the life support and not throw good money after bad. So there was a triage phase. What did we do? We cut salaries, which by the end of the year, I paid that delta cap back to everybody. So that means that there was no negative effect. It was a good year. So I think everybody was taken by surprise that after 1 or 2 months where people were inward looking, they were very quickly outward looking again and doing deals left, right, center. At the beginning, they said, we do deals with companies we already know, with founders we have already met. So the chemistry aspect has been established, and they revisited those deals where they felt comfortable with the theme, where they felt comfortable with the team. But that has also changed. The deals were done completely digitally or remotely, where nobody met in person. So from inward looking to let's do the deals where we're comfortable with, or I don't care, I invest anyway. And that has happened. And it wasn't just investments. It was the equity capital markets were booming, also fueled by the SPAC trend. And M&A was booming. So everything was booming, which I don't think anybody could have predicted.
But the specs are not new at all, are they? Could you recall that those specs are in the late 90s? We had something like this already. So this is not a new invention. It's just that
they newly popular.
Yeah.
It's very popular. And there are certain assets that are prepared for IPO, and then they figured out they get twice the valuation if they are SPAC'd.
Mm. Okay.
So, will the SPAC valuations hold up, fueled by a lot of liquidity? I think some are probably quite good companies and quite good deals, but I don't think all are the same quality. I think some will decline in value over time because they were just overvalued in the first place.
Diana, when did you say it again? Valour was founded when exactly?
So Valour was actually founded 2 years ago, but it was in stealth mode. And so we came out of stealth only in December. I formally joined the team several weeks ago, but have been working with them on the release of their first product and getting to know the team and building out everything there operationally from November, essentially, when I left HSBC.
So we speak about November 2020.
Yeah. So I would say, so prior to that, I was, a head of innovation within a global bank. And I would say that in contrast, I think I did see the increase in interest in fintechs certainly coming from early on. But I suppose in the same way that I had actually left and started working from Canada before the UK lockdown, I'd been hearing quite a bit about the growth of the pandemic itself from Asia, and just from a family in epidemiology, got more nervous. But because of that as well, you started to see that actually, as head of innovation, it was quite a perfect time, because suddenly all of the projects that you've been trying to push in terms of making everything digital were gaining the attention that I obviously feel they rightly deserved. And so that shift was accelerated, essentially.
Just for curiosity reasons, and no need to speak about it if you don't want to, but how did you onboard to the company? Did they interview you on video first, or did you ever meet them already? Or how do I have to imagine that in the midst of all this lockdown? I find this to be extremely exciting. And Gerd also spoke about capital increases or capital rounds on video only. So how did that work out?
Yeah, well, actually, I knew one of the founders for about 10 years now from the crypto space. I'd been working in it, I guess, formally since 2014, and knew one of the other founders as well from the space, from conferences in earlier years. So they were well known to me. They had been reaching out to me for a while, and yeah, we had a lot of virtual discussions.
All right.
During that time.
So it's about
still virtual, because I'm actually still in London. I don't have a Swiss working visa.
Yeah, I see. So this is exactly the same, like Gerd said, that it's mainly based on chemistry of networks and relations you already know. Mm-hmm. So would we expect actually out of all this that maybe the kind of new kids on the block currently find it definitely harder? In particular, also funding. I could imagine that a kind of seed round or something like that, if you're a new kid on the block, you're pretty much unexperienced, maybe unknown, quite challenging, shouldn't it?
I think it depends. I mean, I've heard from people that are having great success and really enjoying doing everything over Zoom, and it hasn't been an issue. I've seen and heard from people starting new roles that it still happened, and they were able to get those positions, and life kind of goes on and you adjust. But obviously there's nothing like being in the room and working with people. So I think a lot of people are looking forward to when that does happen. But I don't think that it's impossible, but it's probably more difficult if you're coming straight out of the gate with no connections.
Yeah, I understand.
If you're a good networker in the physical world, you're probably also a good networker in the digital world. So the ones that you just need to adjust. to try to find the sources of capital. But agreed, if nobody knows you and you are a new quantity, how do you raise your equity value, your brand value? How do you get the audiences or the auditions that you can actually pitch your story? I do think that for some people that are gifted in the digital world, it might have become easier, because what we have noticed generally from a working perspective, working is surely less fun than it used to be, but we are more efficient. You pack your day full with Zoom calls, you're exhausted in the evening. So you do actually, if you're disciplined, almost get twice as much done and have twice as many touch points as you otherwise would have in the physical world. I think people have adjusted extremely quickly.
I did receive a very nice app today. It's called Zoom Escaper. And actually, I really need to forward you the link. It's absolutely fantastic. Or if you Google it, I think...
Teams, right? Zoom Escaper is Teams, right?
No, it's not. It's Zoom Escaper is really, it's more like a joking application in which you can fake that you have kind of acoustical issues. Like in very, it's absolutely fantastic and amazing. It's simulating an echo so that, for instance, that the mic is not working, obviously, whatsoever. It's absolutely hilarious. I only can recommend it. So, okay, I would say, so let me say, learning number one, we see that there's a lot of money flocking into the market and funding is massive. I would say this is more like really like more, this is so far more like hitting more mature companies, more for really real growth funding at massive valuations. We think the whole industry, based on our individual experience, the whole industry copes extremely well when it comes to digital working places, digital collaboration, and so on and so forth. Even onboarding new members to the team, however you know each other. But I think that is still working. I can reconfirm that out of my personal experience. But what is and I have to come back to this capital market, financial market topic one more time. What is next? Whenever. And maybe I'm too incumbent on this. And having experienced one internet bubble burst already in the late 90s of the last millennium, so Diana, nothing to worry for you, but Gerd might recall that.
I remember it, yes.
Yeah.
as do I. I started working in tech in 92 or 94.
All right, good. Great. So we experienced, all of us, that valuations imploded like a fresh souffle leaving the oven and suddenly meeting the hot from the hot into the cold air. So what is our expectations? Do we think we will experience that again, Gerd? Actually, is that all fair?
I think the companies that go public or get funded with big valuations, big tickets, are better companies than in 99. I honestly think that. There have been decent companies in 99, but the internet age was at its beginning. The infrastructure wasn't there. These companies couldn't scale, couldn't deliver in 99. When you look at telecom equipment guys, many of them, or telecoms guys, AltNet guys, they went bankrupt because they just couldn't make ends meet in the end. There are companies that went public, had a market cap of 30 billion with zero revenue. I don't think that happens now. I think some esoteric things got funded in the crypto world with ICOs, but I don't think many people do an ICO these days. But when you look at the SPAC market, the IPO markets, late stage funding rounds, genuinely these companies are good companies. Is the valuation at 50 times revenue or 70 times revenue or whatever some get away with? Are these valuations justified? That's to be seen. But there's one thing for sure, if you look at some of the industry leaders in the payments world, like an Adyen or Stripe, these are excellent companies. They haven't quite set a foot wrong in the public arena. They're doing very well. But they're benefiting from extra liquidity, and I think a Biden 1.9 trillion capital injection into the economy will fuel asset bubbles, perhaps. Will there be a massive correction at some point across the board? It does not look like it. Would companies quickly go bankrupt? I don't think so. Maybe some, because their business models are not proven. But they probably will be the exception. I think these are genuinely good companies. but valuations are very, very high.
Yeah. And I think deeper in comparison to the late 90s, the pockets of investors are deeper. I would say that the investors are definitely more patient and learned their lesson as well. First of all, and the whole market environment totally changed. Just think about it. Late 90s, we did not have smartphones, haven't been around. So now the whole ecosystem actually changed and developed strongly since then, didn't it?
Yeah, I think it's also easier, I think, for many companies to grow faster because the digital world allows them to manage teams better, etc. They're more productive. Barriers to entries are lower. Enterprise software to run any company in 99 would have been prohibitively expensive. Now you go on the internet, you put your credit card down, $300, you have Office 365 for everybody, and it's a brilliant platform to work with. All of that didn't exist in 99. Yeah. So it was harder to manage companies back then.
Mm. And we see companies preparing, obviously, for their maybe public life. Whenever I read the news about, for instance, N26 now killing the free-of-cost cash account or killing the free-of-cost credit card and introducing first pricings on all this, to me, at least, I don't know anything about it, but to me, at least, this reads a little bit like preparing for more monetization and for more public days than ever.
But there are different businesses out there valued highly, and I think in the digital banking space, it's particularly for European ones, it's much harder to make money. And if you look at Chime's business model wouldn't work it's valued at 20 billion now, right? And they're preparing to go public, or 30. Their business model wouldn't work in Europe because there are no interchange fees. In the US, they can get the interchange fees, so they have a secure revenue model, and from a revenue model perspective, they look like a payments business. Payments businesses are fairly predictable. So when they go public, and when you go public, you have to have a proven business model because you need to do quarterly earnings estimates, and if you miss your earnings estimate, you get hammered in the public market. So you need to have a pretty stable business model and need to be sure that your underlying revenue grows at a certain rate that is required to justify your premium valuation. Digital banking in Europe, this is questionable whether these companies are ready to go public. Chime, which has a business model like a payments business, probably that works for them. More predictable.
So, we have spoken enough, I would say, guys, about valuations, going public, private, KPIs, multiples whatsoever. And before our audience actually starts fading away, let's go into a break. But after the break, we will speak about the new technological trends and maybe conceptual trends, what kind of value propositions we see upcoming, and what maybe is the next new hot thing and the next new driver of fintech. So stay tuned.
Do you want to be part of Breaking Banks Europe? Reach out and learn more about the opportunity to be featured in one of our shows. With over 1.6 million listeners and counting, Breaking Banks Europe is bound to become the place to advance critical dialogue in Europe and the UK fintech scene. Reach out on Instagram or Twitter at Breaking Banks EU, or go to www.provoke.fm.
Back again to Breaking Banks session and show number 71 today. We speak about the news and the news from the FinTech Front, actually. Diana, speaking about the maybe next new thing, you yourself work in DeFi, crypto environment. What would you think is the, let me say, 12 to next 18 months actually upcoming of technology? Is there anything new, what we could expect? How is your look on how's your view actually on the whole environment we're working in?
Yeah, so naturally, as you mentioned, my focus is predominantly in the crypto space. So there we're seeing this and it's actually been a trend since last year, is a real escalation in institutional adoption. I think there had been a lot of hesitancy for many years, and maybe projects going on behind the scenes, and now it's really out there, and we're getting a lot of people and a lot of institutions that are actually announcing the fact that they are indeed launching crypto desks, integrating into offerings for their clients, creating new products that will allow their clients to gain exposure, and it's getting increasingly competitive. And that's sort of looking at it just from the financial services side, apart from other types of corporations that have been putting crypto within their treasury. But I think all in all those trends combined has really led to a lot of real interest in the space. But I think that in itself is a sign and a result of the fact that the market infrastructure around crypto is finally getting there. I wouldn't say it's quite ready yet, but there certainly is a lot more infrastructure that makes those markets more professional, more workable, and better trusted. That, as well as the increasing regulatory clarity, we definitely still need more. And there can be a bit of back and forth in terms of sentiment around crypto in general, but definitely we're seeing an increase in private investors, as well as institutions that want to work with it, that want to gain exposure to this, and are seeing it as really a new type of asset class.
So speaking, you mentioned the regulator. This, of course, is my kind of favorite topic to speak about. What would it need if you, kind of out of your perspective, what would it need by the regulators? And speaking about Europe, we not only have one regulator, we have many layers of regulation, and we have many regulators. What would it need to make it, out of your perspective, a more kind of convenient environment? Not saying you do not want to be you do not want to be compliant, but being compliant. But what would it make easier? Do we see that we have a disadvantage there in Europe versus maybe other markets?
No, I would say that Europe is in quite a good place. The focus of our company is actually European for that reason. Of course, yeah, that certainly does vary across different markets, but I think there's a lot of education that needs to happen, and also comfort. And then obviously with crypto for what it is, being seen as a currency as well, there's added complexities there around how and if, because it's also not just a currency. These are protocols, this is software, or there's a large number of different use cases that you can actually build into the protocols themselves, apart from being just a currency. And then, of course, there's the question for some of these projects around whether it is a security or not, and a lot of that still needs to sort of be decided in terms of what those exact rules might be. I think one thing that we would benefit from, or do benefit from in some markets, is clearing certain misconceptions. I think there are still a lot of misconceptions, particularly around Bitcoin, that are out there and that continue to perpetuate somehow through media, and even through individuals that you would think would have investigated further. And maybe that's because those are convenient. Maybe that's because of a true lack of understanding. I'm not sure. And that would be things like, for example, that crypto is used by criminals. We actually, one of the fantastic things about most cryptos, and certainly Bitcoin, is that there is a public immutable ledger, and you can trace every single transaction and see where those are from. And there's great fintechs, like, for example, Chainalysis, that provides that type of analysis and can actually show that, actually it was less than 1% of crypto transactions that had been used for that purpose, which you could not obviously do with a completely fungible asset like cash. So I think though there are quite a few misunderstandings that are still present in the space, and those need to be cleared up. And then there's also the question of allowing retail investors in particular to participate in the space. So the question of at what point do regulators have the right or need to say that no, retail investors aren't allowed to do this? That obviously extends just beyond crypto, but I think, also when we look at like limits in order to be sort of an accredited investor and who judges that, engages that, that's also different from different markets. But I mean, personally, I would be an advocate of saying that obviously there's education that's needed, but provide people with the freedom to participate if they would like to, and just support them in gaining the education and awareness that they need in order to do that in a way which will be a positive, but that in general, it is a positive to let people have that choice rather than imposing on them that yes or no, this is or isn't allowed.
Protection, yes, but do not patronize your customer base. Can we summarize it like that?
Exactly.
How is Gerd? You've been just. I need to kind of expose you on this. You've been a Bitcoin skeptic, haven't you?
That is true. I can tell you why. I have a very good friend who put very good early stage bets into the market. He's a consumer credit specialist. He ran a bank. He even ran a country once. I don't mention names here. He made early bets in TransferWise, in raising all brilliant companies. He turned down Revolut because he wasn't quite sure what they were. And he also put an early bet into Coinbase. And he did, when Coinbase was valued at 1.5 billion 2 years ago, he sold out, although he didn't need the money. He made a very, very healthy return. Coinbase is valued at 80 now. So that 80 billion. So this is a ridiculous multiple uplift. Why did he do that? And that was my reason why I was skeptic, because there was still systemic risk that a US regulator, particularly the US one, I don't think a European one would do that, would kill dollar, Bitcoin or crypto clearing. And that probably would have been the end of it. So there was systemic risk. So it was binary, the risk. That has gone away. And I actually wanted to invest in Bitcoin last April when it was at $3,000, but then it kept on falling at $4,000. And then I didn't have an account and then I forgot about it. And I was busy running a company and other things. I said in November, I should get back into it. Oh, now it's at 14. Oh dear, already lost out. And until I had an account, it was at 28, but I went in at 28. So now it's at 60. So it still looks reasonably decent bet, but $3,000 versus 28 as an in price, that would have been nice if I'd gone in back then. Yes, I was a skeptic. I think my skepticism has gone away. I think, as Diana said, it has reached maturity, the market. It has attracted a lot of institutional interest, and that's not just Elon Musk and others that put money into their corporate treasury. But what we hear from our network in Switzerland is that in the private banking world, in the family office world, everybody wants to have at least a small proportion of their assets in a, call it, digital cryptocurrency. But that's just one aspect of crypto, because that's what's in the media, and that's what you see, and that's where actually the big money was made with Binance and Kraken and Coinbase and others in that space, benefiting from that trend enormously. And these companies were super profitable. They were spinning money. It's the whole kind of infrastructure that's underneath, which is still extremely immature. One has to think through about financial services infrastructure in general, because every single growth investor, every single VC likes new generation financial services infrastructure. And that starts with banking as a service, which is now called embedded finance in the payments world, API-centric payments flows that you can implement into any kind of digital ecosystem. The true SaaS propositions for financial services are still extremely immature, whether it's in wealth management or in banking, or particularly insurance. And the blockchain-based financial services infrastructure, whether it's based on smart contracts for those companies, or it is actually capital markets infrastructure for digital asset trading, is even more immature. So there's much more to come. It's not going away. It will take time. I think these companies, they need longer than a B2C crypto trading play to reach maturity. I would think it will take a decade till we see a real impact. These companies are all really small in terms of their actual penetration in the financial services world. But it's there to stay. It's not going away.
I would say that's a great statement. Diana, you, I guess, fully agree on this, aren't you?
I agree that definitely crypto is here to stay. I think it is in and of itself an evolving ecosystem. So independent of whether you have and how you have institutional adoption. And I think that's just by its very nature as well. And I mean, another fantastic thing about that space is that there is just so much open information out there, and you can actually take a look at the protocols, participate in them, and it's really ongoing and real-time innovation that anyone can be part of. And so that's unlike anything that we've seen, especially in financial services before. And obviously the use cases go far beyond that. So I think it's very hard to draw comparisons or sort of narrow it down to what we have in existing paradigms today in terms of financial services and otherwise. And so the benefits go beyond that, and the understanding that you can have of it is really open for everyone. I think that is why things like, for example, saying that like any particular government could stop or shut down Bitcoin, that's actually just not the case, and not something that would ever be possible, and actually just sort of drives it further. And it's probably, I think, from out of that innovation that we've seen, sort of obviously Bitcoin being the first, and then we had Ethereum in 2015, and that of course then allowed for more sort of programmation on top of blockchain technology. And now there's a lot of work being done. I think the next phase will be just making those transactions more scalable, more affordable as well. And then there's further innovations being built on top of that. And that's how we're moving into this trend that we're seeing in particular for financial services of decentralized finance, or DeFi. I think really, particularly around the ICO boom in 2017, we saw more looking at sort of the types of organizations in general with ICOs in terms of what can be built on top of blockchains like Ethereum. And now we're moving away from that and just looking more specifically at decentralized finance, and that's where we're seeing a lot of the interest, I think, because there's more clear use cases, and obviously that are direct because of the nature of the tokens associated to the protocols themselves, and the types of people that are participating in this ecosystem right now. And then as well, because of the fact that there simply are so many intermediaries to remove, and there has been that lack of innovation overall in the space, as well as it being a space that's traditionally been more opaque, more closed. So transforming that into something open is in itself really interesting. And then from there, actually, the use cases go on, and one more we're seeing are things like NFTs and art. Now, essentially, that's what people hear about. They don't have to think about, do I care about blockchain technology or this or that, but it's creating these use cases that really extend beyond just finance as well. So
you're reading my mind, Diana. I just wanted to say that whatever utility tokens have been issued here or there, I kind of don't get it. I think this is not particularly mainstream. But what will be mainstream is the actual end product that could be sold in a very large market like wealth management, for instance, via the tokenization of certain physical goods. Like you can own a fractional piece of a Mac Rothko painting. Why wouldn't you want that as an asset class, or a boat or a car, or whatever it is, or digital art, where the provenance aspect is important and it all sits on the blockchain ledger and it's yours. And these are things that have been around, but they haven't been mainstream. But I think they will get mainstream because they will be much more tangible. That you say, I invest $20,000 in a 50 million Mark Rothko painting. I get issued tokens. And then I hope that this was a good purchase like any other asset you would have bought. But you couldn't have bought it before because nobody could fractionalize a Mark Rothko painting. I think this will become mainstream over time.
Yeah, you could have fractionalized the painting, but
definitely there was a lot of firms that tried.
Right?
There was quite a few startups, like even back in 2015 that were looking at that particular use case. But I think it's just now that the technology infrastructure is more mature, more accessible, still not totally accessible, as we know from anyone who's made one of those transactions, that if you're doing that on Ethereum, the gas fees are really high right now. And that's something that the teams are working to address. But certainly when those are now more accessible and people have heard about them, and that they know what an NFT is because their favorite basketball team has made a collectible on top of that, and they might not have had any previous exposure to crypto or even care what it is or blockchain technology, but this has provided that entry point. So that's certainly an exciting first use case and one that's clearly already quite rapidly moving into the traditional art world as well, when we see auction houses like Christie's participating.
And I think what technology is now allowing, customer behavior is accepting it. I would say that the markets itself are actually driving it because people or investors more and more have the feeling that they reach the kind of ceiling for valuation for all kinds of asset classes and really looking desperately on the markets to find new alternative into whatever kind of interesting asset classes. And this is why I think also from that direction, it's driving actually into this whatsoever widest range of tokenization and saying, listen, I need to tokenize almost all and everything, more or less, now overdoing it, in order to have additional investment opportunities.
Well, absolutely, because it's a combination of the drivers from the market environment, from negative interest rates to just a lot of uncertainty, and then you have a younger generations who are digitally native, as well as like older generations who are also just forced into the digital world more and more because of the current circumstances. And they're all stuck at home as well. So looking for something to do. Maybe they're unemployed or they're getting a stimulus check and want to participate in the investment ecosystem, which before was inaccessible and today is accessible in a number of different ways.
All right. So one final topic, actually, before we leave the show then, is something I wanted to speak with you about it is, and maybe more personal or professional look to this. What about gamification and FinTech? Because I think this is something like also a very hot topic that we, not only since Robinhood and others and the GameStop development, we speak about in the industry very, very often. And yes, that's a more like B2C related topic, while we spoke more about B2B. I give you the intro statement to this, or maybe you have an idea to this. Do you think gamification, we will see more of that within our industry, or is it changing the whole thing, or what's happening? How to deal with that?
One has to describe what gamification means. What I do believe, however, is that the concept of embedded finance, which is the new word for banking as a service, will become ubiquitous. So it will be much more like an experience, a digital experience like in WeChat, where you do certain things that required you in the past to go to the bank to queue up and transfer money, which was quite painful and cost a lot of time, to do that without even noticing that you do it. And if gamification plays a part in that, whether it's on the more, but trading is more fun than investing. So how do you make investing so more patient investing, more exciting? Maybe there is a gamification element that gives it a little bit more appeal to let's say a younger user group to start not gambling on Robinhood, but actually taking decisions for the long term. I absolutely think there's a place for gamification, particularly in a digital environment where things will change and will become fairly frictionless and effortless over time.
And in particular, because we have 3 billion people using video games day by day, more or less. So I think they are quite used to this. Diana, any thought to this? Are you playing video games?
I used to quite a bit, not anymore. I guess just with the word gamification when it comes to financial services, you want to be careful there. Certainly what we were looking at when I was leading the innovation team at a retail bank was the use of behavioral economics. And so how to sort of understand more how consumers are thinking and what would provide the motivation that they need in order to create positive choices around their financial lives, essentially. And then in that, really taking that into a more streamlined, as Gerd was mentioning, streamline services so that they have sort of less decisions to make, but at the same time are completely aware and empowered of what's happening. But you're putting more and more things that, especially using technologies like AI, that are sort of in the background of your overall experience, so that it's not always something that has to become, a tense or a difficult decision, but rather that you are able to be guided into making the positive ones, and then obviously have the transparency that these digital tools can also provide into what the consequences and the implications of your actions are, and how to really improve your life that way through using the digital tools to manage your finances.
Wonderful. Yeah. So if that would be the outcome, great. So we have to wrap up, actually. Time is over. And I will not let you go before you do not share me one kind of sentence or statement. Now, thinking ahead and maybe thinking into the future, and we are living in the year 2022 or later, what do you think the year 2021, maybe this COVID environment, what do you think when we look back into history then? What will we remember or recall that year we are currently in? What do you think will be our statement out of the future, looking into the past in which we are today, into our here and now today? Gerd, you are, as an Austrian, which is the home of a lot of philosophers.
One pretty prominent late-stage venture firm describes the investment theme as based on the GDP of the internet. And the GDP of the internet continues to grow. Hence, FinTech continues to grow, at least most aspects of it. And there are lots of things people will think about 2021 and 2020 and what COVID did. But what it definitely did was an acceleration of all of those trends that would positively or negatively influence our society. And digitalization has probably taken a several-year leapfrog during the last year.
I most recently heard a quote from a Google guy saying that what they normally would have done in one product cycle of 7 years, they had to do in 1 year now during COVID. And when I look to the consultancy industry, I have to say 20 years of consultancy didn't make in digitization what COVID did do in 1 year, isn't it?
It's very true. People only adapt when they have to, right? Think about your 6 o'clock morning run. When you were 25, you didn't need to do one. Now you need to do one, so you might force yourself to do it. Now, if people are forced to do it, and if they start doing it and doing it and doing it, suddenly it becomes second nature, becomes normal. So I believe there are massive changes how we work, how we will work, although we all want to go back to the office because the social interaction we all miss, and work is more tiring and more boring. But from a technology perspective, from a digitization perspective, things have definitely leapfrogged several years.
Diana, what is your prediction how we will see the current days out of the future looking back then? What do you think?
I think we'll see it as the inflection point from which crypto and these blockchain protocols move from being magical internet money and for us being in the space, being kind of these idealists or worse, and there's a lot of other names that people use for people in that space, to really, I think, more and more and sort of the world understanding the opportunities with the sort of financial protocols and economic protocols that are built into the internet and inherently digital.
All right. So, Diana, thank you so much. Gerd, thank you so much for joining us on the show today. I hope we all stay healthy and we will have the opportunity to double check on our predictions in some years, maybe next year to come. Thank you so much again for that open conversation from the front of FinTech. This was Breaking Banks, episode number 71. Thank you guys for joining us.
Thanks for listening to Breaking Banks Europe, a Provoke Media podcast in cooperation with FinTech Stage. Don't forget to tweet us out, shout out, or post to the team at Breaking Banks EU on Twitter. If there's something or someone you'd like to hear on our cast, let us know. See you next week on Breaking Banks Europe.